Pairing up with Ironside's macroeconomics. It's Sunday evening, February 27th. You'll all either be listening or watching this on Monday, February 28th. I suspect a fair bit will have changed in terms of where the markets are by then. S&Ps are currently down 79 handles. They were down 120 earlier. That struck us as a massive overreaction to the potential for a systemic liquidity event resulting from the restrictions for two big Russian banks and the Russian central bank to the SWIFT payment system. Russians have plenty of collateral, plenty of reserves. There's obviously always settlement related risks. There's been some good things written about this around the street over the weekend. We've spent some time talking about it, thinking about it. We just don't see this as a significant probability of a real systemic event, even compared to March 2020. If you recall, at the time, the Fed was doing not QE, buying 60 billion worth of bills per month to add additional reserves into the banking system. Well, right now there's 4 trillion in reserves. There's probably no more than 2 needed, maybe less than that. And there's 1.6 trillion in the Fed's RRP program. So there's plenty of liquidity in the US. We suspect there's sufficient liquidity in Europe, and there looks like there might be some workarounds for Russians to be able to settle financial transactions. Other than that, you've got the Euro stocks down a little bit more than S&Ps. Crude is up $4.40. That's off the highs. 10-year bond yields are down a little less than 5 basis points, and the euro's down about 85 basis points. If this were a true risk off related to a potential liquidity funding crisis in Europe, you'd expect to see the euro down more than that and treasuries up more than that. This looks to be mostly an equity related event, which to us makes no sense. In fact, from a US investor perspective, we can see some net positives to all this. Now, our comments are going to sound fairly sanguine in the face of a horrific situation for the Ukrainian people and likely for the Russian people as well. We're saddened by the collapse of the thesis of the end of history. China's going down a dark path. Russia's going down a dark path. It is not a good time from a geopolitical perspective. And so were we writing about that, we'd be far less sanguine than we are writing about the implications for investing in US assets. So the title of our report this week was Deglobalization. And that's because we view this as the third major supply chain shock in 4 years that is going to further promulgate that deglobalization trend that was already well underway in the 2010s. There's 5 sections to the note this week. The first one is our typical market summary. It's titled, It's Still Primarily About the Fed. We then wrote about deglobalization and mocking the end of history. We then wrote about central banks, core inflation, and the risks of much greater energy price pass-through on a go-forward basis. Then we wrote a section on capital investment, which we think is going to be in the US a byproduct of that deglobalization trend that's rebuilding the US capital stock. And then we gave you a macro preview. Next week is going to be a very big week, separate and distinct from the comings and goings of the Russian invasion. We've got a lot going on here in the US. And as we've said, this really still is primarily all about the Fed. We really had only one risk-off day, and it wasn't even a full day. That was on Thursday. On Wednesday, when S&Ps were going down, bond yields were going up. Our Fed policy proxy, the 3-month rate, 18 months forward, less the current 3-month rate, or just the 2-year note yield, those went up all week. This is still marching towards tighter Fed policy. There's a thesis that the Fed may not want to go 50. They may not even want to do 25 because of this crisis. Most of the Fed speakers pushed back on that. There was one in particular very interesting speech from Fed Governor Bullard. We highlighted that in the note and talked about how he wants to end all reinvestment of mortgage prepayments as soon as they get started with balance sheet contraction. He looks like he doesn't want to start till July. We think they're going to get pushed to start in May. July is too late. That will just further exacerbate the problems in the housing market. There's going to be a speech on Thursday night from Lori Logan, who's in charge of implementing QE at the New York Fed. That could be very interesting. It's about the Fed's balance sheet. So we'll be watching that speech carefully. In addition, of course, to Powell's finally getting his monetary policy report to Congress. He will be testifying to the House on Wednesday and the Senate on Thursday. Again, we think this is about the Fed. That's the reason we would have likely had the retest with or without the Russian invasion. Clearly, the Russian invasion contributed to negative sentiment, and it is part of the reason why we did make a marginal new low. We bought into that on Thursday. The VIX 1-month, 6-month curve got 5% inverted. That is at a very extreme level. We used that as an opportunity to add. In that case, we bought financials because they were down more than anything else that morning, and we think it's an overreaction to the risks of a systemic liquidity event, as we've been saying. But we would suggest on any weakness, if we open anywhere near where we are right now, which is below 4,300 on the S&Ps on Monday morning, we would suggest putting some money to work. So moving on to section number 2, which is deglobalization and mocking the end of history. As we've shown you, global trade growth basically slowed by a factor of about 50% in the 2010s versus the 90s or O's. And that ratio of that to industrial production, which is a sort of our proxy for globalization, that fell considerably as well. We think it's going to be further catalyzed in the 2020s. And if you think about it, yes, the economics have been largely mitigated of producing products in China or Eastern Europe and shipping them all over the world by the middle 2010s. But businesses are struck by inertia like everyone else, and without real catalysts to restructure their supply chains and make those big investments, they didn't do it. Well, we've now had 3 major supply chain shocks in 4 years. The Trump trade war, the pandemic, and now the Russian invasion. Those are catalysts to go to what Honeywell's former CEO called a locally sourced model, which is you produce where final demand resides. In that case, we're going to be rebuilding our capital stock in the U.S., at least here in the old NAFTA block. So we really do think that's a big byproduct of this Russian invasion and the pandemic, obviously, as well. Now, there's good news and bad news from this. First, the bad news. The bad news is this is another inflationary shock. And central banks over the years have come to believe that the reason we had disinflation was because of central bank policy, what they describe as credibility. We disagree. We think that it was the Chinese labor and Chinese and Eastern European labor supply shock that put downward pressure on goods prices for decades. The shale oil revolution put downward pressure on energy prices, and technology innovation adoption in the delivery of first consumer goods and then consumer services, the e-commerce Amazon effect, all those things put downward pressure on consumer goods prices. It had little or nothing to do with the Fed. And you'll see in a chart that we'll add to the video, at least, or if you were a subscriber, you would have seen it in the weekly, how energy prices were very closely correlated with goods prices and service prices in the 60s and 70s. They then became unmoored. But so far in the 2020s, they are moving together. And we think there's a very good chance, particularly with all the green policies, that energy prices are going to start passing through. Energy and commodity prices are going to pass through to other goods prices on a go-forward basis. In particular, if we're right about deglobalization, that could be the case. And so central banks are going to have to get out of this core inflation mindset and realize that energy and commodity price pass-through could be a big risk on a go-forward basis. That's the bad news. Negative for bonds in the long run, no question about it. The good news, though, is with deglobalization comes a capital spending boom, and one is already well underway. If you account for CapEx for the S&P 500 the way the government does, which is to say you add research and development to capital investment, research and development expense, that is, S&P 500 CapEx is 21% above the peak in 2019 before the pandemic. It's 17.4% above where it was a year ago. And that's despite energy CapEx at only 26% of its 2015 peak. So industrial still on the come. Energy is going to come back, notwithstanding all the hostile administration policies to developing fossil fuels. We are on the verge of a CapEx boom. Last week, we got positive news from regional Fed spending surveys. Their 6-month forward capital spending plans numbers were at their highest level now since the pandemic hit. Because you have to go all the way back to the passage of the Tax Cuts and Jobs Act pre the Trump trade war to find CapEx plans as strong as they are right now. Core capital goods orders, the portion of the durables report, that portion of the durables report was much stronger than expected for January, and the GDP revisions showed stronger structures and equipment, CapEx, intellectual property products, which is research and development, and software investment. That was already booming, up nearly 11% year on year, likely to get stronger still. Our favorite way of playing this is being overweight the industrial sector. So on balance, Russia for us, we do not think will have much impact on near-term U.S. growth demand. We do think it'll be a net positive for CapEx. Remember, in our way of thinking about this, the mix matters. CapEx is a better form of growth. Investment's a better form of growth than consumption, and this will push us towards that. And we do think it's inflationary, so we reiterate our underweight of bonds, our overweight of equities, in particular reflationary sectors, and would buy on any weakness here. Looking forward to next week, away from the Russian invasion, we get manufacturing PMIs on Tuesday, auto sales, that's very important. Auto sales are very important to look at to get a sense of whether supply chains are starting to clear or not. The State of the Union address on Tuesday night. As we mentioned, Powell's monetary policy report to Congress beginning on Wednesday, then again on Thursday, that Lori Logan speech on Thursday night, productivity revisions on Thursday, jobless claims, and then of course, that granddaddy of all of the economic indicators, payrolls on Friday. The forecasts look a little incongruous to us right now. Expectations are for no increase in participation and slower employment growth, a number like 400,000 down from the 553-month and 6-month average. Those two numbers are consistent, but what's not consistent is a slowing of wage growth that's expected. You shouldn't have that. All the indicators of wage growth are really strong. Without participation going up, wage growth is likely to continue to be exceptionally strong. We do think the work week will pick up. The street is expecting it to go up by 1/10. We think it should be stronger, likely will be stronger than that. And if not in February, then it'll come in March with Omicron fading and work weeks lengthening because people aren't testing positive and not able to go to work. So that's it for us. We may put out a preview for our paid subscribers on the employment report prior to that, sometime on either Wednesday or Thursday. Have a good week, everyone. Buy weakness here. We do think we've already had our appropriate adjustment to Fed monetary policy tightening, and we don't see the Russian invasion as a big negative for U.S. growth, though it clearly is a negative for U.S. inflation. Barry Knapp, Ironsides Macro. Have a good week.